is just kind of there. All right. So we got 30 minutes here. All right. So another concept I want you to understand is something called a triple double for real estate investors. The triple double for you basketball fans, it's a little bit different because the first is what we call triple compound interest. Now, I'm sure earlier we talked about compound interest. What I want you to understand is triple compound interest. Triple compound interest is something that we all want and aspire to. We just may not know it. Sometimes when we get compound interest, we think we're getting triple compound interest and we're not. What is triple compound interest? Well, it's actually very simple. Triple compound interest is when you put money in from an investment standpoint. You put in your principal gains interest. Once you gain interest, now both your principal and your interest generates more interest. So that's compound interest. I'm getting interest on my interest and my principal. But triple compound interest is when you get interest on your principal, interest on your interest, and interest on the money that you didn't pay in taxes. Because normally when you have a capital gains or some sort of return, part of that money you have to pay taxes on. But in this situation, I'm not paying taxes. So that just means that's more money generating interest that I have that I ordinarily would not have had if I use some other vehicle. That's what you get here is triple compound interest, because the interest on your money is making you money, and the the money that you're not paying in taxes is also getting you more interest. So let's walk through that. So let's say, for example, we look here, same policy illustration at year 5. So this is another thing I want to break down, where cumulatively we put in $150,000, and it looks like to the average eye that, well, man, I put in $150,000, but my policy value is only $134,000. I thought Kelvin said these things were so good. This doesn't make any sense. I actually got less money than what I invested. Well, that's actually not what's really happening. Because what's really happening, we got to remember a couple things. Oh, let me back up. Yeah, so what we have to remember is each year, don't forget the $6,000 that we pay yearly for our life insurance policy. So because we're paying that every year. We're paying that every year. So again, like I said, we got to pay somebody. We got to pay IRS, or we got to pay IRS, or we got to pay the bank or the mortgage company on interest, or we got to pay the insurance company. We got to pay somebody. The question is, who's going to give you the most? IRS, not going to give you anything. The insurance, the bank or the mortgage company, they're going to take a lot of interest. So you're not going to get anything back from that. So at least here, we're paying our money and we're getting something for it. So if we really look at the numbers, we say year 5, I've put a cumulative amount of $150,000 into this policy, but $30,000 of that went to pay for my life insurance. So I can't really count that. So that's 628 times 5 is 30. So what I really put in here, the part that is actually growing, was the 118. And this 118 is what grew to 134. Okay? Because you gotta pay somebody. At least the insurance company is giving you something for your money. But what's left, that money has grown to 134. So where before it looks like you actually lost money, you actually made $15,000, which is a 12% return. That's pretty doggone good. Now, why did I talk about triple compound interest? Because if I had taken this 118 and invested it somewhere and made 12%, let's say, and I had to declare this as ordinary income, just for federal, not including state. Let's say I'm in a 24% tax bracket. Well, I would only walk away with about 8,000 of that 15,000, which would be about 7.4%. Actually, not a bad return, but it's not as good as 12. See, what's happening is we're making this money and we're, hey, man, I'm doing real well. I got 7%. Well, you could have had 12%. So 7.5 is not bad unless you know you could have had 12. Now, 7.4 doesn't sound as good because the money I'm getting here, I get to keep this. I don't have to pay any of this in taxes. Now, let's say we did something and it was more like a capital gains where we're around 21% between state and federal. So I still walk away with a little bit more, 9,629. So that's about an 8% return, but it's still not as good as the 15%. So again, when we're talking about triple compound interest, this really starts to take fold, obviously, the longer we go into it, because again, all this money that I'm not paying in taxes, it just starts to mushroom and snowball. So let's look at 10 years in. Same thing, still had to pay the insurance company for, for my insurance. So I got to deduct 62,000, which means out of the 330, I really have 267 left over, but that 267 has grown to 347. That's 30% rate of return. If I had to pay taxes on it, 16%. Capital gains, 18%. So you can see when you're looking at triple compound interest, the numbers start to get really ridiculous. We go to 81% rate of return versus 45 or 49. So again, the benefit of this part is just to understand that, you want your principal to earn, you want your interest to make money, and by virtue of the fact that it's a tax-free product, meaning I never have to pay taxes on the gain. So my interest is making me interest, and the money I'm saving on taxes is also making me interest. So these accounts start to balloon astronomically once you get them going, okay? Which is, again, the other reason why you want to put more money in, because the money I put in here is going to grow on a triple compound interest basis versus money I put into anything else, IRA, 401k, Roth. I mean, well, Roth is you'll get tax deferred, but you may not be able to touch it, and you could potentially lose it if it's in the market. So all of the self-directed, the Roth IRA, the real estate, all those sort of things. All right. So that's triple compound interest. I want to get to the real estate part here. We got about 30 minutes. Okay. So this is one of the things when I learned about how these tools work, I call it the double duty. You'll hear some people call it the double play, how to get your money to work in two places at once. Once again, when you look at what the wealthy do and how they leverage this, it just makes sense, because who wouldn't want their money to work in two places at the same time? But the question is, nobody tells us how to do that. All right, so let's go into that. And this is where we're going to use examples of real estate. And then after this, we'll wrap it up. All right, so we're looking at our same breakdown. So let's say, again, around the year 11, we want to do a real estate deal. So we're going to, like I said, tax-free, question-free, penalty-free, before 59 and a half, no credit check, no nothing. Pick up the phone. We call the insurance company. We say, send us a check for $100,000. We want to do a real estate deal. So watch these numbers. So what happens is that 381 is going to switch to 280 because you pulled 100,000 out. The policy value actually goes up $1,000 or so. Not really going to get into math. Let's just say there's a provision in here where When your death benefit is lower by a slight amount, you pay a little bit less, but I don't want to get into the technicalities of it. But just understand that you have taken a loan, policy loan for $100,000. Now, I'm showing you not paying any more premium. See how the premium stop? Because I want you to see the easy math. The money you've taken the $100,000 out of your line of credit. Let me make sure I have my attenuation here so you guys can see. So you've taken the $100,000 out of here, and you'll see we're not putting any more money in. So what I want to show you is, even though the $100,000 is out of here, this number really didn't change. Remember, it actually went up by $1,000. So again, this is the equity in the house. This is your line of credit. So just because I open up a home equity line of credit doesn't stop my house from increasing in value. I just have a line of credit. Same thing here. Just because I have a $100,000 loan or line of credit, it's not going to stop that same $100,000, because this number didn't change, it didn't go down, to continue to work for me. So I just take the $100,000 out. I haven't done any deal yet, but the $100,000 is still inside here and it's still working. So the next year, again, I didn't put any money in. So just off of the interest, it generated $24,000, which goes back to my line of credit. The next year, it generated, because if you take the difference between 430, it generated $25,000, which goes here, which means, see, my line of credit has gone up. So it's going back up. Even though I've just taken $100,000 out, I haven't put any money in, but my policy is putting the money back for me. So this is just showing that even though I took $100,000 out, that $100,000 as a part of this 4110 is still working for me. So the money inside my policy never stops working. The only question is, what am I doing with the $100,000 I took out? Now, maybe I just took this out to, I don't know, do a trip around the world with the family, or, you know, pay for some extravagant wedding for, you know, my daughter or something. So in that case, you're not making money at two places at once, but your policy is still making you money. So literally, if I didn't pay anything back in 1, 2, 3, 4 years, my policy would put the money back into my cash value, and then I could borrow it again. But that's not what we're talking about. What we're here going to talk about is our money working two places at once. But just understand that our policy value, or the equity, is going to continue to go up. And that $100,000 is not going to be deducted from this side. So my money is still working for me, even though, you know, I've got this line of credit over here. My money is still working for me here. So that's one place where it's working. But let's say we go ahead and we take that $100,000 and we do a real estate deal. We take the $100,000, we get a property. You know, maybe this is purchase and acquisition, and it's fix up, or the whole nine. So we fix that property up, and now we sell that property for $150. Okay. So again, I already showed you, while we're doing this, the money in my policy is still working. But let's say this project takes us a year. So one, I pay my $100,000 back because I got the $150, and I put the $50,000 back into my policy. Now the next year, remember, I told you the policy that first year made us like $24,000. So you would think by putting the 100 in and the 150, the difference is going to be like 150,000. But when you actually do the numbers, The difference is between the 280 and the 454 is 174. But Kelvin, I only put in 150. My policy is still making me money. So that 100,000 in the policy as a part of this 400 is generating income. And if I'm fortunate enough to make money on my real estate deal and I put it back into the policy, then now I've got that. I paid the 100,000 back. I got the extra 50, and then my actual policy made me an additional 24. So I netted 174. So I made 150. I made 50 outside of the policy, but I made 24 inside the policy at the same time. My money is working in two places at once. One in the real estate deal, two in the policy. So I'm gonna stop here in a minute, just because we're about to wrap up, because this is the part I want people to understand if you have any questions. All right, so let's go. And oh, by the way, this 174,000 that I can use again, I can borrow it again for another project, is tax-free. The money I made on the real estate may not be, but the money I made in here is. All right. All right. So let's say we go another year and we say, oh, we want to do another deal. So now I have 531,000 because my money, while I'm waiting for deals and while I'm looking for deals, while I'm shopping for deals, my money is still making me money in the policy. Now, let me pause here for a minute because this is something I see that a lot of real estate people make a mistake with. And I've done real estate for a long time, and I know a lot of people do real estate. The issue becomes you're only as good as your last deal. Because what happens is people find themselves where they need to do a deal to generate revenue because they're essentially living off of that, their income. When you have your policy set, when you have your finances set up this way, where your money is already making 7, 8, 9, 10% without you doing anything. So I'm not really necessarily pressed to find a deal. I'm going to look for the best deal. And if I don't find a deal I like, well, my money is still making me money. So my money is making me money while I'm waiting. So you got to find, or I have to have a deal that's really good for me to take money out of my policy where I'm getting easy 7, 8, 9% and do this deal on the real estate side. Because why would I risk that when I can make 8% in my sleep? Why am I going to risk it on something else? And it's just going to keep compounding, or I should say it's going to keep triple compounding because the money I get here is tax-free. So I could be very discerning when I do real estate. I don't have to be anxious at all. I'm going to just take the best deal because even if I don't do a deal, I'm fine because my money is making money for me either way. All right. So let's say this next year, we're going to step up. We're going to get into some multifamily stuff. So we find another property and we want to do 300,000 now. Because let's go back. So I don't know if you guys missed that. See, we're at 531. I'm going to pull out 300,000. So that went down to 226. Here's my 300. Again, there's a little bit of interest in there. That's why this number is a little. Remember, I told you got to pay 2.25%. So my 300 is there. I have a property. I take this 300. I do the property. I fix it up. Let me. I fix the property up, and I sell it for $450 or something like that. Now, watch this. I'm going to take that money. I'm going to put it back. I'm going to pay back my loan that I borrowed from myself. Why? Because I'm my own bank. I'm paying myself back. Now, I already showed you, you don't have to pay yourself back. But why wouldn't you? Because any money you put in here, it's going to continue to grow 7, 8, 9, 10%, and it's going to generate you more tax-free money. So the more money you put in, the more money you can take out. So I would recommend you put the money back, and especially if you don't have anything you want to do with it. Now you notice here, I put in 300, but I only put in 100 here. I didn't put in 150. Why? What happened? Well, at this point, and I probably could have showed it here, but I just decided to show it here. Because this is a real estate deal, we are going to have to pay taxes on the gain. So I'm assuming that, you know, after depreciation, write-offs and stuff like that, you owe about $50,000 in taxes. Okay. Now, here's the beauty of this. So even though I made $450, $50 goes to taxes because you got to pay Uncle Sam. $400 goes back into my policy. $300 to pay the loan back. $100,000 is the premium. When I look at the rate, that's a difference of $419. Now here's something that's pretty astonishing. I only put in $400, but I got a growth of $419. I think this is tax-free. So what's this saying? Basically, in the first year, you can look at it a couple of different ways. The policy is paying the money because, again, remember, this number never goes down. It just continues to generate interest, and either it's paying money on top of your credit line or it's paying back what you took out of your credit line, but it's always going to pay on your cash surrender value. So you can look at it this way, in that in the first year, my policy reimbursed me 20% or $20,000 of the $450 of the $50,000 that I had to pay in taxes. Why do I say it that way? Because there are very few tools or products where, if just by virtue of the fact of how they're designed, it's going to compensate you for the money that you have to pay in taxes. So literally after a year or two, probably the next year, you will have gotten back or will have put back in that other $30,000 in addition to all the other interest that you're making, to essentially bring you back to square one. So here's the thing. We all have to pay taxes. No question about that. It's just part of the deal. But if I could be in a situation where that money is essentially reimbursed to me through some strategy, because now whether I do another deal or not, I'm going to get that money coming back to me, because I already showed you how your policy value is constantly sending money to your credit line. Whether you do anything or not, you can stop making premium payments. It's still going to pay you. Okay, so we're about ready to, so let me stop there and just ask, does anybody have a question? I know we're getting a little technical, but any questions, comments, you can put it in the chat. Just let me know, or give me a thumbs up if you understand what I'm saying, or give a thumbs down if you don't understand, because this is the part I really wanted people to get that most people miss. So if I lost you, we can go through it again. But the whole point is you're making money. Okay, Gabe got the thumbs up. The money I'm making money outside of the policy, and I'm making money inside of the policy. It's the same money. This $300,000. See, we're at 478. Let me just explain this, because like I said, when this first hit me, I almost fell out of my chair. Before we borrowed this 300, we had 478, we had 454. After we borrowed this 300, we had 226 and we had 551. My money is still, so that 300 never went anywhere. It's continually to give me compound interest. I'm just borrowing from my credit line to do this deal, and then hopefully it's a successful deal. And then I put the money back Why? Because I have an incentive to put the money back, because once I put this money back, my credit line goes back up and I get an extra 19, 20,000 to use on another deal, or you just use on whatever I want. And if I don't do anything else, this money just keeps growing. All right, so I think I saw a question. Looks good. Okay, thanks, Kim. All right, so let's wrap this up. So this is the question that I know I get. I'm at the point I can read minds now. Because let's go back all the way back to the beginning. And we're going to wrap this up here. Let's go all the way back to the beginning where, we put the policy information in. So remember, this is what the policy looks like at 7.2%. So you have a couple different types of policy, because like I said, there's the relationship between cash value and rate of return. So here we have access to less cash value early, but we don't have to go for that option. If you want to have access to more cash value sooner, you can. You just have to give up rate of return. So the insurance companies make you pick. You can have a high rate of return and low cash value to start, or you can have a high cash value and low rate of return. You choose. Now, obviously I say, oh, I want high cash value. Well, maybe you do, maybe you don't, because it's like most things in life. It looks good in the beginning, but you're probably not going to like so much how this story ends when you know what you could have had. So at 7.2%, this is what we were putting in. We know we had, our money was growing at a pretty good clip. Unfortunately, we had 0% right away, but over time, our money is growing. So at 61, we got $2.4 million. All right, so we already know that scenario. But if we wanted to look at the cash value. So if we wanted to go with another option where we had cash value pretty soon. Now this works very well. And this means, hey, I can start doing deals even sooner. No problem. Problem is your interest rate is going to be lower. So even if I put in the same amount of money, yeah, I get my cash value sooner. I get that. I get access to my money sooner. Nothing wrong with that. I love it. But remember that $2.4 million we had at the end of 6, that basically cost you $1 million. Now, maybe you're going to make it up on the real estate side. And you're like, Kelvin, that's all right. I'm going to make it up on the real estate side. Okay, I get that. But I just want you to know, in terms of it's relative, meaning everything I talked about earlier in terms of how much money your policy value was paying to your cash value, we'll just cut all those numbers in half. Because, and again, it might be okay. So it's one of those things where, pay me now, pay me later. You can get the high value, or you can get the lower interest rate. Now let's go to the end game and look at, the scenario I talked about where, hey, if I'm getting a good 70.2%, I get that 3.5, that's almost a 300% return. And I can pull out, hey, some good money somewhere in the neighborhood of $5 million, yada, yada, yada. My family gets 1.8. Because at the end of the day, this is where I'm looking for clients to be. Because again, you still have a lot of real estate you can do in between there. But at the end of the day, it's about how much money do you have in your later years, your golden years, that's tax-free. If we did this at 3.5%, it looks a little bit different. Still have that 1.1, but it hasn't really grown all that much. About 140% return. I can barely get 7, 8, 9 years of. Now, I don't have to pull this much out, so I don't want to be deceptive. You could, hey, if you only wanted to take out, say, 125 a year, then it would probably continue much longer. But I'm doing apples to apples. I just want you to see that the lower rate of return has a significant impact on the end game. So before you make a decision to say, hey, I want the option where I get the early cash value, just know you may be doing that at the risk of losing something on the back end. So before, where we're able to pull out $5.7 million, here we're only to pull out 1.6, which is pretty much about what we put in. Again, it's not good or bad. It's just understand. I mean, it makes sense. If you're getting almost twice as much in terms of your rate of return, you would expect to have, you know, a significant amount of money. But here, you know, if you can have your access to your cash value sooner, it just may cost you in the back end because you're going to get a lower rate of return. So again, it's not wrong. It's just, you know, what do you want to do? And I'm going to go back here and just say this. When we look at these sort of tools, you know, this is generally where people use that whole concept of infinity banking, where because the money is almost immediate, and, you know, in some instances you can, you know, you might even be able to get higher, then they simply just they put the money here, it grows tax-free, you can access it tax-free, but they usually actually pay their bills from here, and they essentially put their whole paycheck in here. So they use it like it's a savings account or a checking account, because what they're trying to do is get the difference on the interest for their money while it's sitting there. It's a technical term called arbitrage. But basically you're just getting the difference of why my money is sitting there in the bank, because look at where your money's sitting in the bank now at 0.05% maybe, versus sitting here where you're at the minimum you're going to get is 0.75. So that's already 6 times what you're getting in the bank, and that's the minimum. So on average, if your money just sitting there, you're going to get a much better rate of return. But that's a whole nother, I mean, I could do a 3-hour presentation on that alone. So, all right. So I think that's, where are we at? We should be right. Yep. 3 minutes early. So that's pretty much what I wanted to run through. Again, if anyone has any questions, I could take some quick questions. And